In the vast ocean of global finance, few instruments are as complex, mysterious, and misunderstood as derivatives. They exist everywhere, quietly embedded within every major financial institution, every corporate balance sheet, and every government's debt strategy. Yet for most people, they remain invisible. What began as a tool to manage risk has evolved into one of the largest, most interconnected webs of speculation the world has ever seen. A market so enormous that even the people who built it can no longer map its full scale. Derivatives were originally designed as a safety net. Farmers once used simple contracts to lock in future prices for their crops, protecting themselves from uncertainty. But in modern finance, those simple agreements have multiplied into a universe of instruments worth hundreds of trillions of dollars. Futures, options, swaps, and credit default contracts that now dictate the rhythm of the global economy. They were supposed to make the system safer. Instead, they became the very thing that could bring it down. Today, estimates place the notional value of the derivatives market anywhere between $600 trillion to over $1 quadrillion. To put that into perspective, that's more than 10 times the value of the entire global GDP. It's a market that doesn't exist in the real world, yet its consequences shape everything from interest rates and inflation to the stability of entire nations. After the 2008 financial crisis, the world was supposed to learn its lesson. Governments promised tighter regulation, and banks claimed they had reduced their exposure. But what truly changed was not the system. It was the illusion of control. Instead of shrinking, the derivatives market became even more concentrated, more automated, and more dependent on mathematical models that very few truly understand. The players got smarter, the trades got faster, and the risks got bigger. At the center of this labyrinth are the major financial institutions, the same names that dominate every market headline: JP Morgan, Goldman Sachs, Citigroup, Deutsche Bank. Together, they hold the majority of global derivative exposure. On paper, these instruments offset each other, every loss matched by a gain somewhere else. But that balance only exists as long as every counterparty fulfills its obligations. In a crisis, when liquidity dries up and trust disappears, that balance collapses like a house of cards. Think of derivatives as invisible threads holding the financial system together. Each thread represents a promise, a bet that something will or will not happen in the future. When one of those promises is broken, the shock spreads instantly through the entire web. That's what happened in 2008, when mortgage-backed derivatives imploded and cascaded through the global banking system. Trillions vanished overnight, not because the assets were gone, but because the confidence in those promises disappeared. Now, more than a decade later, the same structural vulnerabilities remain. The difference is scale. Governments, corporations, and even central banks are now deeper in debt than ever before. Interest rates have swung violently, currencies are destabilizing, and global liquidity is tightening. Each of these variables directly affects derivatives contracts. When volatility rises, margin calls trigger, and counterparties scramble to cover their positions. The entire system becomes a ticking time bomb, fueled by leverage, complexity, and human greed. One of the greatest misconceptions is that derivatives are off balance sheet and therefore harmless. In reality, they're hidden leverage, invisible to most investors, but capable of amplifying shocks across every asset class. A small movement in bond yields or currency rates can cascade into billions in paper losses for institutions that appear perfectly healthy. And because these exposures are interconnected through layers of swaps and contracts, no one truly knows who owes what to whom until it's too late. Even the world's largest financial regulators admit they don't have a complete picture. The data is fragmented, intentionally opaque, and often outdated by the time it's reported. The system runs on faith. Faith that every player will honor their bets, that every algorithm will execute correctly, and that central banks will step in when things go wrong. But faith is not a strategy, it's a gamble. What makes the derivatives market so dangerous is not just its size, but its fragility. It's a market built on models, mathematical assumptions about volatility, correlation, and liquidity. These models work beautifully in stable times. But in moments of panic, when human behavior becomes irrational and correlations break down, those same models fail catastrophically. The numbers stop making sense, the computers start liquidating, and before anyone can react, trillions in synthetic value evaporate. We've seen the warning signs before. In 1998, the collapse of long-term capital management nearly brought down the global banking system because of over-leveraged derivative positions. In 2008, credit default swaps magnified the subprime meltdown into a worldwide financial crisis. Each time, governments intervened, printing trillions to stabilize the system. But every bailout, every rescue, only made the system more dependent on artificial support. Today we stand at the edge of the next great unwinding. Interest rate volatility is at record highs. Global debt has surpassed 300 trillion, and derivatives tied to interest rates now account for more than 80% of all positions worldwide. That means if rates spike or currencies collapse, the chain reaction will be immediate, affecting banks, hedge funds, corporations, and eventually you. The story of derivatives is the story of human ambition, our attempt to control uncertainty, to profit from risk, to engineer safety in a world that resists prediction. But in trying to eliminate risk, we created something far more dangerous: systemic fragility on a scale never before seen. The global financial system is now a tower of promises, and when one promise fails, everything connected to it begins to shake. The lesson is simple but profound: the bigger the system becomes, the more fragile it is. And when the derivatives bubble finally bursts, it won't be one market that falls. It will be the entire structure of modern finance, collapsing under the weight of its own invisible complexity. Derivatives began as a simple concept designed to protect people from uncertainty. In their earliest form, they were straightforward agreements between two parties to exchange something at a fixed price in the future. Farmers used them to secure prices for crops before harvest, ensuring stability against unpredictable weather or market changes. But as the financial world evolved, that same principle was adopted by banks, corporations, and investors seeking not just protection but profit. They discovered that by trading these contracts, they could speculate on price movements, interest rates, currencies, and credit risk without ever owning the underlying asset. What started as a safety net became a highly profitable arena for betting on the future, and over time, it grew into one of the most powerful forces in the global economy. As technology advanced and financial engineering became more complex, derivatives multiplied in form and scale. Futures, options, swaps, and credit default contracts turned into sophisticated tools that could be structured in endless variations. Each contract represented a bet, a promise, or a transfer of risk. These instruments allowed institutions to hedge exposure, manipulate balance sheets, or create leverage far beyond their actual capital. For the financial elite, derivatives became the ultimate tool of control, enabling them to profit in both rising and falling markets. But behind the complexity, few truly understood how deeply these instruments were reshaping the foundation of global finance. The growth of the derivatives market was exponential. By the early 21st century, it had expanded into the hundreds of trillions of dollars, surpassing the size of the real economy many times over. What once existed as a practical hedge for farmers and manufacturers became a speculative web linking the world's largest financial institutions. Every contract was tied to another, forming an invisible network that spanned continents and asset classes. Banks became interconnected through these instruments, creating dependencies so intricate that no single entity could map or control the entire system. The notional value of these contracts exceeded global GDP by more than tenfold, a staggering number that revealed how much of modern finance was based not on tangible assets, but on synthetic promises of value. At its core, this evolution represented a fundamental shift in the nature of capitalism. Real production and tangible goods became secondary to financial engineering and abstract trading. Profit no longer required creating something of value. It could be generated through speculation, leverage, and the manipulation of risk. The boundaries between investment and gambling blurred, and markets became driven less by economic fundamentals and more by algorithmic reactions to price signals within this derivative-driven ecosystem. This transformation was celebrated as innovation by those who benefited from it, but in reality, it sowed the seeds of extreme vulnerability. The derivative market's complexity made it nearly impossible for regulators or even participants to fully comprehend the risks embedded within it. Every contract was intertwined with countless others, meaning that the failure of one could ripple through the entire network. This evolution, from a simple hedging mechanism to a colossal speculative architecture, turned derivatives into both the engine and the potential detonator of the modern financial system. After the collapse of 2008, the world was promised reform, transparency, and control. Regulators, politicians, and central bankers assured the public that the lessons had been learned and that such a systemic failure would never happen again. They created new rules, introduced stress tests, and demanded higher capital reserves from banks. But beneath the surface, the same dynamics that caused the crisis were quietly being rebuilt, only this time with more complexity and less visibility. The derivatives market did not shrink, it expanded and evolved, becoming even more integral to global finance. Banks adapted by moving much of their activity into less regulated arenas, using subsidiaries, offshore entities, and private contracts to bypass the oversight meant to contain them. The appearance of safety replaced actual safety, creating an illusion of control over a system that was now more fragile than ever. In the years that followed, central banks became the new backbone of financial stability, pumping trillions into the economy through quantitative easing and low interest rates. This easy money environment made risk cheap and leverage irresistible. Instead of reducing exposure, institutions doubled down, creating layers of derivative positions built on artificially stable markets. Every bond, loan, and security was hedged, swapped, or securitized into complex structures that only a handful of specialists could decipher. These instruments promised precision and predictability, but their very design depended on the assumption that markets would remain liquid and orderly. That assumption became the foundation of the illusion, a belief that models and mathematics could manage chaos. The perception of control was further reinforced by the technological transformation of finance. Algorithms replaced traders, risk was managed through real-time data, and advanced analytics gave institutions confidence that they could anticipate volatility before it arrived. But technology only amplified the scale of risk-taking. It allowed millions of trades to execute in fractions of a second, multiplying exposure faster than human oversight could track. The same systems that created a sense of order also ensured that when something went wrong, it would happen faster and spread wider than ever before. The illusion of control was sustained by speed, automation, and complexity, which concealed the fragility that had taken root underneath. Meanwhile, derivatives became even more concentrated within a small circle of global institutions. A handful of mega banks controlled the vast majority of outstanding contracts, creating a system too interconnected to fail. Regulators could not allow any one of them to collapse without risking a total financial meltdown. This concentration of power made the illusion complete. The public saw a stable financial system on the surface, while behind closed doors, trillions in hidden bets tied every major player together. Each institution's survival depended on the others, and each was confident that central banks would step in if things unraveled. In this belief lay the greatest risk of all, for it transformed moral hazard into standard practice. The illusion of control was not just institutional, it became psychological. Markets began to operate under the belief that governments and central banks would always intervene to prevent collapse. Investors no longer feared risk, because they believed someone else would absorb the consequences. The system became self-reinforcing, feeding on its own confidence, blind to the dangers it was amplifying. By turning fear into faith, policymakers created a paradoxical form of stability, one that looked strong but was built entirely on dependency and denial. The very efforts meant to prevent another 2008 became the foundation for the next inevitable crisis, ensuring that when it arrived, it would strike a system far larger and far more fragile than before. The modern financial system operates like a living organism, its lifeblood flowing through a dense network of interconnected institutions bound together by trillions in derivative contracts. Banks, hedge funds, corporations, and even governments are linked through layers of promises that depend on one another's solvency and trust. This web of financial interdependence was built gradually, trade by trade, until it became so intricate that no one could trace where one risk ended and another began. The same contracts that were supposed to distribute risk evenly instead created a chain of dependence, where a shock in one corner of the market can trigger a ripple that spreads across the entire world. Every institution believes it is protected by hedging its exposure, yet the very act of hedging transfers that risk somewhere else, ensuring that it never truly disappears. It merely changes form and location within the global system. The concentration of derivative exposure within a few massive financial players makes this interconnection even more dangerous. A small group of global banks controls the vast majority of derivative contracts, acting as both counterparties and intermediaries for almost every major financial transaction. JP Morgan, Goldman Sachs, Citigroup, Deutsche Bank, and a handful of others sit at the core of this structure, creating an environment where each institution's stability depends on the other's ability to perform their obligations. This concentration has turned competition into dependency. If one major bank fails, the others face immediate contagion through the derivative positions they share. The system has effectively become a circle of mutual exposure, where every participant is both creditor and debtor at the same time, making the concept of isolation or containment almost impossible. This interconnectedness extends far beyond the walls of Wall Street. Corporations use derivatives to hedge interest rate and currency fluctuations. Governments use them to manage debt costs, and pension funds use them to stabilize returns. Every layer of the economy is tied to the same underlying network of financial promises. When market volatility rises, these contracts begin to strain, margin calls increase, and institutions are forced to liquidate assets to meet their obligations. What begins as a small tremor in one market can quickly evolve into a systemic shock. This was seen in 2008 when the collapse of mortgage-backed derivatives spread through the banking system, freezing global liquidity within days. The problem was never just bad loans. It was the chain reaction of interconnected bets that magnified those losses across every corner of finance. The fragility of this system lies in its illusion of balance. On paper, every derivative contract is matched by an opposing position, creating the appearance of neutrality. But this balance only holds in a world where all parties can meet their commitments simultaneously. In reality, liquidity, trust, and timing are the invisible forces that keep the structure from collapsing. When confidence erodes and one counterparty defaults, it sets off a cascade that no model can predict or contain. The interconnections that once made the system efficient now make it explosive. The global web of derivatives has created a financial ecosystem where no institution can fail alone, and no crisis can be local. Every movement in interest rates, currencies, or credit spreads reverberates through the entire network, proving that the system's strength is also its greatest weakness. The world's financial stability now rests on a foundation of mutual dependence, where the failure of one promise can ignite the unraveling of them all.